Well, welcome. Today, we will be presenting our 2023 legislative landscape, expanding opportunities for manufacturers. My name is Ron Wainwright. I'm a partner in strategic tax advisory with Cherry Bekaert, and I'm also our energy leader, where we'll speak today about very specific provisions within the Inflation Reduction Act of 2022. I've been a partner at Cherry Bekaert for 12 years. And I sit in Raleigh, North Carolina, and we welcome all of those who are attending today. And thank you for attending. Well, we have a lot of information to cover, so we want to go ahead and get started. So in 2022 and 2023, just to really level set, we saw significant tax legislation in the 117th Congress as they concluded. The most recent of four pieces of legislation was ultimately the passage of the omnibus legislation signed by the president after Christmas, but at a $1.7 trillion amount. And that'll become important. So when we talk about the accomplishments of the 116th as well as the 117th Congress to lay some foundation around the tax legislative landscape, we know we saw the Infrastructure Investment Jobs Act, which was signed November 15th of 2021, $1.2 trillion of two pillars of funding, $715 billion, which was really left over from the COVID Relief Act, and another $550 billion of new spend in regards to really rebuilding the infrastructure of the United States. We then, to the accomplishments, saw the creating helpful incentives to produce semiconductors, acronym the CHIPS Act, at $250 billion. Most people understand that the CHIPS Act is attributable to $52.7 billion, but in fact, that is what was authorized, and then what was ultimately allocated was an additional $200 billion over a 5-year period. And this, as we'll talk, is a very specific piece of legislation for manufacturers who are either manufacturing semiconductors or supporting and manufacturing machinery and equipment to ultimately manufacture semiconductors. We then saw the Inflation Adjustment or Reduction Act of 2022, often referred to as IRA. $500 to $600 billion of investment. So when you think about the August 9th piece of CHIPS, the August 16th piece of IRA, and then ultimately the $1.2 trillion that was the Infrastructure Act, we're talking about close to $2 trillion of federal tax legislation with respect to credits, deductions, rebates, and exemptions to subsidize very specific areas of our economy that all impact the manufacturing industry. So when we think about what has occurred since 22, and now look over the horizon for 2023 and what can we expect around a tax legislative or continued tax legislation, let's break it down a little bit. So we know the 118th Congress has now been seated. It took 15 votes to ultimately elect a Speaker of the House on the Republican side, as the House now turns to a slim majority with very specific camps attributable to the Republican Party caucus. We know that the Senate remains in a very slim majority on the Democratic side. So as the 118th Congress is now sitting and looking at continuing and looking at legislation that needs to be addressed, what do we expect? The general view is we expect a stalemate, where we will likely not see tax legislation in the 118th Congress and then the 119th Congress when you go into 2024. However, there have been some key changes that we want to make sure that we're paying attention to as we look at the tax legislative landscape. The first thing we want to make sure is that we understand the Senate Finance Committee. Now, once again, when we think about the Senate Finance Committee, that has been and continues to be controlled by the Democrats. So two key people that we want to pay attention to from a Democratic perspective is Senator Wyden out of Oregon. He has been on the committee and ultimately chairs the committee. The minority in the Senate Finance Committee is Senator Mike Crapo out of Idaho. And both of them have been on the Senate Finance Committee for some time. The reason that this is a key committee to pay attention to is that they both have come out already in the 118th Congress with areas of tax legislation and changes in tax legislation that they would like to consider on the Senate side. But as we all know, ultimately tax legislation begins on the House in the House Ways and Means Committee. So it's a key to pay attention to this committee. And therefore there have been changes as the Republicans now are in the majority, though a slim majority in the House of Representatives. So who are the key people to pay attention to now? Jason Smith out of Missouri is now the chair of the House Ways and Means Committee. Representative Smith has been in the committee since really a long period of time and is very pro-growth when it comes to tax legislation. So it'll be interesting to see as he and other Republicans set the policy of potential tax legislation coming out of the House Ways and Means. The minority is Representative Richard Neal out of Massachusetts. Now, Representative Neal has also been on the committee for some time. And so you are dealing with two experienced individuals along with other members of the committee that we will likely see a number of pieces of tax legislation that ultimately come out of committee and may pass the House and then be sent to the Senate. But it is likely, to the comment made, it's a stalemate that it will ever rise to the level of being voted on in the Senate unless we can find some areas of bipartisanship support. So let's look at a little bit of a deeper dive, specifically when we go back and look at the omnibus bill that was passed and signed by the president after Christmas. Now, there were a number of pieces of tax legislation that were bipartisan that were going to be within the omnibus bill. But three key areas that we want to focus on as we look backwards and then forwards from a tax legislative perspective. What was and what was not in the omnibus bill. So there were a number of what were referred to as pro-growth provisions in the omnibus bill. These were areas that had bipartisan support, both Democrat and Republican, that they being the bipartisanship agreed that these were changes in tax law that needed to be addressed. Specifically, the pro-growth provisions, what we call kind of the top three, start with the research and development credit, or Section 174. So coming out of the Tax Cuts Jobs Act of 2017, there was a sunset provision. Historically, when you think about R&E or R&D expenses in our country, they are allowed for tax purposes to be deducted under Section 174. However, the Tax Cuts Jobs Act sunset that deduction, and effective January 1 of 2022, those R&D expenses and broader expenses in Section 174 were to be capitalized and amortized over a 5 or a 15-year period. That was a significant bipartisanship agreement that needed to be repealed because it was a national security threat. When you think about research and development being done in the United States, we are the leaders of the world in innovation. In 2021, the last measurement date we have, there were $500 billion of R&D spend in our country driving this innovation. So think about that in the context of now adding $500 billion back into taxable income of taxpayers and then needing to amortize that over a 5 or a 15-year period. Unfortunately, Section 174 in the late days of the 117th Congress fell on the cutting floor and did not make it into the omnibus bill. The second pro-growth provision that was closely paid attention to was bonus depreciation, which came through the Tax Cuts Jobs Act of 2017 to immediately expense CapEx type expenditures that was very specific to the manufacturing industry when you think about machinery and equipment, changing lines. So any class life asset that was 20 years or less was immediately being able to be expensed of 100%. That now changes in 2023 to 80%, again, coming out of the Tax Cuts Jobs Act of 2017, and begins to phase down from 80, 60, 40, 20, and ultimately expires to 0. So that's why it was called a pro-growth provision, because post the Tax Cuts Jobs Act of 2017, what we saw was a significant spend, not just in the manufacturing industry sector, but really across all industries with respect to CapEx expenditures. The last pro-growth provision that unfortunately also got cut and is on the floor so that the omnibus bill could pass was in fact what is referred to as the interest expense limitation of 163J, which was going to move and is moving from an EBITDA, where you calculate the limitation on earnings before interest, tax, depreciation, amortization, now to EBIT. So a significant reduction as to the application of the limitation, which will ultimately cause more interest expense to be limited, certainly in the manufacturing space, but really across all industries. These pro-growth provisions were more on the bipartisanship side, both supported by Republicans and Democrats, Democrats being in the majority at the time. But unfortunately, at the last minute, it was pitted against what's referred to as the child tax credit, which again also expired. So what was not in the omnibus bill was the pro-growth provisions, and what was not in the omnibus bill was the reinstatement of the child tax credit, whereby dependents could receive a credit, or in fact a refundable credit for dependents, i.e. the child tax credit. So the other area of key focus is, of course, the debt ceiling debate. And we all have begun to see the 118th Congress sit, now underneath Speaker McCarthy, and the pitting of the Democrats and the Republicans around the debt ceiling. The debt clock, which I checked right before this presentation, currently stands at $31.6 trillion. Now, you may recall from a debt ceiling debate that the government has already begun, under Janet Yellen, Secretary of Treasury, to begin to take extraordinary measures so that we do not go over the debt limitation. And so that's where we're going to pay close attention to, can we in fact find compromise between the Democrats, the Republicans, and independents, because we have a pending national crisis in regards to the debt and funding or continuing to fund the government. Secretary of Treasury Yellen has already again started taking extraordinary measures and has indicated to Congress, both sides of the aisle and the independents, that the country will run out of funding probably in the May timetable. And that's where the first and highest priority to pay attention to is the debt ceiling debate. Obviously, the Republicans have their views and the Democrats have their views. In the very beginning, President Biden has currently said that I am not interested in any discussions with respect to negotiations around increasing the debt ceiling that is tied to, so to speak, Republican pro-growth and or other provisions they may consider. Ultimately, what we have to pay attention to when we think about the 2023 tax legislative outlook is, what is the vehicle for tax legislation that the 118th Congress could attach tax legislation to, because it is unlikely that it would be a standalone piece of legislation. So what to expect? There are major transportation bills that must be addressed for the country. I think we're all aware of what occurred in the airlines being shut down because the pilots could not get real-time accurate information. And so the entire country shut down for a period of time and no flights were in the air. But the bottom line is that what is looked at from a tax legislative overview is that could be the only piece of legislation that could be attached with tax legislation. So we really do see, going back to the comment prior, is really a stalemate, if you will, of not really a lot of tax pieces being addressed, whether it's pro-growth, those provisions I mentioned, or the child tax credit, or other areas that the representatives and senators feel need to be addressed. So let's go on to the next slide here and really talk about what was referred to as the creating helpful incentives to produce semiconductors. Now, a little bit of background on the status of the semiconductor legislation is, again, this was a major piece of legislation passed with respect to what we all know is going on is the importance, and it even became more important during COVID, around the semiconductors, which drive really manufacturers, automotive, and other types of machinery and equipment throughout our country. And so the CHIPS legislation specifically is an attempt to pull back the manufacturing of semiconductors into the United States. Since August 9th, when it was passed, and again, remember that there's $250 billion attributable to credits, deductions, rebates, and exemptions attributable to stimulating manufacturing with respect to semiconductors and those manufacturers that support semiconductors. There have been over $200 billion of announcements across 16 states since August 9th. So it is making an impact. Obviously, when you think about an advanced manufacturing facility of the size and depth and breadth, Micron announced $40 billion of a new manufacturing facility in Ohio. But of course, that takes time. That'll probably be a 3 to a 5 year build for sure. But it's very important for manufacturers who are considering, should we begin to build a facility to manufacture semiconductors, if we have that technology, if we have that knowledge. But more importantly, it's important for manufacturers to understand there are significant credits, deductions, rebates, exemptions attributable to the support of the ultimate manufacturing facility, whether it be a Micron or a Wolfspeed in Raleigh as an example, that just announced $5 billion. So it's very important to pay attention to that, because there are benefits attributable to you manufacturing machinery and equipment that are ultimately used in that state-of-the-art semiconductor facility. That's where I speak to funding and credits. Within the CHIPS Act, there are significant areas of funding and efforts, guaranteed loans and grants to assist manufacturers to move this or shift this paradigm to U.S. manufacturing of semiconductors. Probably the most significant piece is what is referred to as the advanced manufacturing credit, which is an investment tax credit. It is 25% of the total spend of that facility is going to be a federal credit. So think about $40 billion being spent by Micron to build a semiconductor manufacturing facility. They will earn 25% of a federal credit, a subsidy, which is attributable to building and ultimately manufacturing semiconductors. There's also what is referred to as 48C, which came really underneath the Inflation Reduction Act of 2022 that we'll touch on for manufacturers, that is $10 billion of the ability to receive funds from the federal government to assist and build in regards to what is referred to as the manufacturing credit, as well as there's other credit provisions that we'll talk about. But the key here from a tax legislation perspective is that between the Infrastructure Jobs Act of 1.2 trillion, the CHIPS Acts of $250 billion, and then ultimately the Inflation Reduction Act, all having credits and deductions and rebates and exemptions attributable to manufacturers. That is all law. Most importantly, in the Inflation Reduction Act, it is permanent law through 2032. So let's talk a little bit about what we saw with respect to the Inflation Reduction Act. I want to spend some time because this is very impactful to the manufacturing sector. So what we'll do is we'll cover a little bit about the Inflation Reduction Act of 2022. We'll talk a little bit about tax credit basics because there's numerous expanded credits and new credits within the Inflation Reduction Act, all attributable to manufacturers. We want to talk a little bit about how in the Inflation Reduction Act, it linked those credits or bonus credits to job creation through specifically what's referred to as prevailing wage and the apprenticeship program. And I want to cover the clean energy credits so that you see the impact that is to the manufacturing industrial sector. And then there has been a significant paradigm shift with respect to what is referred to as credit monetization. How do I monetize these new or expanded credits? So let's get a little bit of background on the Inflation Reduction Act of 2022, signed August 16th. So there were revenue raisers, approximately about $700 billion, but very focused revenue raisers in regards to the piece of tax legislation. 15% AMT attributable to C corporations with book income greater than $1 billion. And then ultimately a 1% excise tax on what was referred to as stock buybacks. That was really attributable to some of what occurred with the CARES Act or the COVID Relief Acts in 2020, where those funds actually were used by taxpayers to buy back their own stock. So that they put a penalty provision, if you will, in place. But now let's focus more on what's in the act from the standpoint of climate tax expenditures. Again, the act is about $500 to $600 billion. It has significant extension of tax credits for renewable energy with respect to wind and solar, and then new tech neutral credits, as they're referred to, really technology neutral credits that begin in 2025 in two key provisions. All of this with the backdrop of the Inflation Reduction Act of 2022 is the single largest investment in our history attributable to subsidizing, incenting, and ultimately supporting through guaranteed loan programs and grants the green, clean energy economy to make us ultimately carbon neutral in 2025. And so that is why I specifically highlighted there's a new credit of 45Q that manufacturers can take advantage of with respect to carbon capture from the standpoint of that credit was there, but the new credit is much richer. There's also a new clean hydrogen production tax credit in the event that you are producing hydrogen. And so we'll see manufacturers move to hydrogen production facilities. There are new credits for renewable fuels and definitely new credits for really any manufacturing activity. And then electric vehicles, we've all read about those. There's new credits for electric and fuel cell vehicles, both residential and building and energy efficiency deductions and credits also were expanded. And as I said, significant, we'll get into it, ways to now almost immediately monetize the credit, and then ultimately a transferability provision was there. So let's talk about the Inflation Reduction Act and how it uses tax policy to subsidize and incent what is referred to as the green, clean energy economy. There are really provisions in the Inflation Reduction Act where there's penalties and there is incentives. On the penalty side, there's new taxation around carbon emissions, taxation of use or production of fossil fuels, i.e. a carbon tax. And then the term carbon pricing, which often is confused, is a reference to a cap and trade system which we are moving directly into to carbon neutrality. Again, the goal, if you read the Inflation Reduction Act, is to make the United States carbon neutral with respect to greenhouse gas emissions by 2025. And this has also become important from an ESG perspective for corporations and companies. So those are some of the penalty provisions. But the incentive provisions is that there are hundreds of incentives for green activity, such as capturing carbon, the new carbon sequestration credit at a much higher level, and using or producing renewable fuels or hydrogen in manufacturing facilities. And what McKinsey, which is a McKinsey and Company, came out with a national report that indicated over the next 3 to 5 years, manufacturers will really be looking at their distribution centers as well as their manufacturing facilities to more of a green, clean energy, given the cost of electricity and kilowatts. So these tax incentives, as an FYI, could take the following forms: credits against tax liability, lower rates of tax on income or excise taxes, and really bigger deductions for expenses and faster rates of depreciation depending on the asset. So the Inflation Reduction Act is a major impact to manufacturers. So when we talk about examples of tax credits for green and clean energy, let me give you a sense of what we're talking about. Here are all the different types of projects and technology that now and traditionally have fallen within the green and clean energy, often called the sustainable or sustainability. So obviously we all are familiar with wind and offshore, renewable natural gas, sustainable aviation fuel, solar, carbon capture and sequestration, battery storage, clean hydrogen, geothermal. All of these that are highlighted on the screen have expanded or new tax credits to drive manufacturers and other industries to use those credits and those deductions and those rebates and those exemptions to subsidize a paradigm shift from a manufacturing perspective. So a lot there. So let's kind of walk through a refresher on tax credit basics. The one thing I would also go back to in regards to this example is when you think about, I'll say historically, around the Inflation Reduction Act, Congress has historically provided tax incentives for a variety of renewable and clean energy activities. However, the Inflation Reduction Act really addressed the extension, the permanency of all of these credits through 2023. And really starting in the January 1 of 2023, which we're already in, all of this takes hold. It covers a much broader scope, as you can see on the screen, and it increases what are called bonus credits, specifically to the extent that the manufacturer and or other industries are taking advantage of these credits and deductions. And then ultimately, as I mentioned, there's a shift in paradigm and it facilitates what is referred to as monetization. So let's go through now just a refresher for everyone around tax credits and benefits. So what is a tax credit? Very straightforward. It's a government subsidy worth $1 of credit is worth $1 in reduction of tax liability. Where if I was dealing with some form of a depreciation, which is also in the statute, you take that dollar deduction and multiply it by the tax effective rate. So obviously a tax credit against a current or future tax liability of the manufacturer or the taxpayer that can be carried forward is worth much more. And that's what we saw in the Inflation Reduction Act, significant amounts and expansions of credits. Of course, there's also a concept from the standpoint of, can I utilize it from the standpoint of what's called tax capacity? But post to the Inflation Reduction Act, certain credits, as I've already mentioned, generate an immediate cash refund to the extent it exceeds your tax liability, i.e. that direct pay. So when you think about the two primary credits that we're dealing with, and we're talking about at a broad stroke in regard to the Inflation Reduction Act, there's the investment tax credit, which is a one-time credit, can range from 30 to 50% depending upon the asset, or what is referred to as production tax credits. Now, a production tax credit is a simple example is a kilowatt hour being produced in a solar array. And therefore, you have a production tax credit over a period of time. And then, of course, when we think about credits and benefits, as I already mentioned, the accelerated depreciation is going to be significant depending upon the type of asset. Often we get the question, are there limitations around credits? And ultimately, what we'll find in the Inflation Reduction Act as well. So yes, there are limitations in regards to these credits. However, really the limitations apply only to individuals. Individuals generally cannot use these credits. So that's not who we're talking about today. We're talking about manufacturers. Closely held corporations can use these credits. And there are some at-risk rules. But ultimately, keep in the back of your mind that credits are limited to 75% of the taxpayer's tax liability. Now, to the extent that I mentioned the carry forward, if I'm not going to sell the credit, if I don't have the tax capacity to use that credit, that first year credit, ultimately, in the Inflation Reduction Act, we saw a 3-year carryback of all credits and then a 23-year carry forward of all credits. So they expanded the ability for manufacturers as well as any taxpayer taking advantage of these credits to ensure that they could monetize them. I want to go through a little bit of overview of clean energy credits. The investment tax credit is really Section 48. So you'll hear a lot about various, 48Y, 48X. Just remember that that's an investment tax credit. It's a one-time credit. It's based on a specific percentage of eligible basis. Example, 30%. The advanced manufacturing credits, 25% that I've already mentioned, and it is allowed when that asset's placed in service. We find this most frequently used in the past in solar. However, there is the other production tax credit, or Section 45, again, that credit over a period of years, and traditionally that was most frequently used for wind. However, in the Inflation Reduction Act, it spawned 45Q, the carbon capture credit, clean hydrogen credit, and clean fuel, just to mention some examples. So where's the paradigm shift when we think about credits and jobs? I've mentioned this several times, and I want to really kind of talk about it from the standpoint of what's the catch when we think about how they have now tied credits to jobs. Well, ultimately, from a policy perspective, they wanted in the Inflation Reduction Act that is a significant impact, as well as the CHIPS Act, to create jobs, and more jobs. So how did they do that? So for most clean energy credits, the credit is contingent on compliance with what's referred to as prevailing wage and apprenticeship requirements. So what does that mean? So there are what are referred to as bonus credits or multipliers up to 5 times of a base credit to the extent that you meet the requirements of prevailing wage and what is referred to as the apprenticeship compliance. So if you do not meet it, that quote credit received is going to be worth 80% less. If you meet it insofar as the prevailing wage and the apprenticeship programs, then you will receive a 5 times bonus provision. So what does it mean when we think about constructing an asset when we talk about ITC? So in construction of whether it's an advanced manufacturing facility or an expansion of a current manufacturing facility, that labor must be paid at what is referred to as the prevailing wage, which is outlined by the Department of Labor underneath the Secretary of Labor. There are also a requirement. So they want you to pay a prevailing wage in the creation of these jobs to build or construct or expand or renovate a manufacturing facility, but they also want to create a program in regards to what are called labor hours around apprenticeship type programs. And so what that means is that a portion of the workforce that is assisting in regards to this manufacturing facility has to be attributable to apprenticeships or tied to a community college or some form of a university. So example, I have 100 workers. I need to make sure I've been based on the dates of application of the 10, 12.5, and 15% over time, that I have 10 out of my 100 workers that are a portion of a apprenticeship program. Now, the service has just recently given us guidance attributable to this, but keep in mind it applies to both contractors and subcontractors, and as well as it applies to alterations and repairs during the entire credit term attributable to that facility. And so ultimately taxpayers are going to ensure and must ensure that the contractors in their contracts commit to this compliance. When do these requirements apply? January 1 of 2023. We get the question often is, well, are there cure provisions? You know, if I don't meet a prevailing wage, because again, there's only been recent guidance from the Internal Revenue Service, and they were very clear that it was in fact initial guidance, if you will, in regards to prevailing wage. So if I don't meet it, does that mean I'm penalized? Well, no, because of the cure provisions. So you can satisfy the wage requirement if you pay within 180 days following the IRS's final determination, and you bring that back up. So there are some cure provisions. However, if you had an intentional disregard to wage requirements, then there are penalty provisions per worker, and they are pretty stiff, as you can see on my slide. There are other similar cure provisions with respect to apprenticeship type programs, but prevailing wage and apprenticeship programs, very important to understand. When we talk about extra bonus provisions, there's also in the Inflation Reduction Act, bonus provisions for location, which are what it's referred to as an energy community. So you get an extra 10% credit, depending on the credit we're dealing with. These energy communities you can really refer to as brownfield sites, in essence, areas which recently closed due to a coal facility or some adjoining census tract, or specifically in the oil, gas, coal, kind of some of the higher unemployment numbers that we're seeing from a national average. These are what are referred to as energy communities. And as you would imagine, since these areas are measured at 2009, you need to pay attention to those as you are looking at potentially building a new facility in regards to maybe an onshoring of a manufacturing facility in the United States. There's also additional credits attributable to low-income communities. And so that's an additional 20% ITC credit. So you ultimately could reach a 70% credit depending upon the type of asset or facility or expansion of a manufacturing facility we're talking to. And then this is where you will want to make sure you're focused is there's domestic content. You get 10% credit or more if you're the iron and steel that you're utilizing in what you're manufacturing is 100% made. There's other manufacturing projects of 40 to 50% by cost. So there are very specific domestic content requirements that you can earn as a supplier to a manufacturing facility where they want to make sure that they have the appropriate domestic content. And as I've highlighted here, you literally could get in a very conservative manner up to 50% credit, as well as all of the depreciation benefits there. And specifically when we get into what's called potential production tax credit for renewable power, let's assume you want to put a solar array on your distribution center, or you want to look at another alternative energy with respect to the distribution center or the manufacturing facility. Above and beyond the depreciation, you could earn up to 50, maybe 70% of the credit. So you can see the power of the Inflation Reduction Act provisions. So when we talk about green and clean energies, I'm going to move through this fairly quickly, but I just want to make sure you're aware of what is out there from a tax legislation perspective. Section 48, ITC for energy property, 30% of the cost basis. Again, after 2022, you could earn plus 10% domestic content, plus 10% energy community, plus 10 to 20% for low income community. So do know that you cannot claim an ITC and a PTC on the same facility. One of the keys here is to see extended by IRA to apply to projects that begin construction before 2025. And that means not only in a new build, but that also means in a renovation or an expansion of an existing facility. So Section 48, very important from an energy property perspective for manufacturers. There's also 48E, and there's also other ones that talk about standalone storage batteries. So if I wanted to put a solar array and have a battery storage where I can do some peak shaving in my manufacturing facility, pay attention to this. 45, which is the PTC, that's the renewable power generation. This is the production tax credit. The increase of 1.5 cents per kilowatt hour indexed to inflation. Basically, it applies for a 10-year period, but pay attention to PTCs because you're going to want to evaluate ITC one time, but I can do bonus credits, or PTC over 10 years. You're going to want to know a net present value. Obviously, we are here to help you do that. There's the new Section 45Q carbon credit, specific dollar amount. This is all about carbon sequestration insofar as minimizing the greenhouse gas emissions. And there's very specific rules, but it is a 45Q carbon sequestration credit, an amount for 12 years from the date of the carbon being captured and stored. And the capture and the sequestration does need to be in the United States. But here's some examples of things in manufacturing facilities and other areas that ultimately generate carbon or greenhouse emission. Coal-fired power plants and petrochemical plants and ammonia fertilizer plants, potentially natural gas burning power plants. Obviously, there's also direct air capture facilities when you think about artificial trees. All of these can be a carbon sequestration credit, as well as any industrial production processes around cement and steel. So specifically, that's where 45Q came into the law around the carbon capture and the sequestration credit. You have to begin construction if it's a new facility before 2033 and place it in service by 2039. But note that the credit goes up from $85 once you put the prevailing wage and apprenticeship requirement in place. Again, an increase of credit from 85 metric tons of carbon to that's permanently sequestered. This is a slide that I want to make sure you're aware of. It increased from $60 to $85, as I've already mentioned. The other thing that the Inflation Reduction Act brings is new clean hydrogen production tax credits. These are very important when you think about 45V. And there is an increase in this chart that shows you the credit value and the per kilogram, as well as my comment around likely only green hydrogen and then blue hydrogen. There's the 45V credit amount, which talks about carbon emissions and how it's determined in the life cycle greenhouse. The 45V, again, just continuation of what we're talking about. But note the caret stacking and racking. 45V and 45Q on the same facility? No, but 45V and 45V will apply for wind, solar, and used to produce green hydrogen. So there is a difference between blue and green hydrogen, as we know. There's clean fuel production credits. This is a new credit. It applies to transportation. There is a carbon intensity provision that talks about clean production around hydrogen and fuel and new tech neutral, which I mentioned. Carbon intensity, you'll hear that term a lot. It means the new emphasis on determining how clean your manufacturing and production process is. And then there's credits for manufacturers of clean energy components. So in the event you're manufacturing that'll ultimately be used in what is called a clean energy build, such as a solar array or a microturbine, hydroelectric, geothermal, et cetera. So there are credits for manufacturers of clean energy components. Here's an example of a credit that could be earned. If I'm manufacturing a photovoltaic cell or a solar module or a blade for a microturbine, you as the manufacturer of that earn the credit under 45X. And then the paradigm shift. This is where underneath the Inflation Reduction Act, it changes dramatically. Historically and traditionally, when you think about how credits could be monetized, I mentioned to you that there were, in fact, limitations from that standpoint. But now, beginning January 1, 2023, you have a direct pay, which is a government refund of the credit, even when the recipient of the refund has no tax liability. Or you have a transferability, which means I can sell the credits. If I'm dealing with direct pay, it's really attributable to applicable entities, tax-exempt organizations, states, political subdivisions, but there's also a two-tier system there. The paradigm shift is that existing tax equity markets had really been premised on need for investors to have ownership in a project. That has gone away, as well as how you would allocate the credits. And so traditional tax equity had what was called transactions where you had a flip strategy, where you had a tax equity investor coming in and there was a development of a project. And then ultimately the tax equity investor would receive the investment tax credit and the depreciation to make sure that that tax equity investor was in essence buying the credits. There are significant movements in the tax equity market to really that provision probably won't apply much more, because you now have these direct pay credits where the taxpayer can elect the amount to be treated as a payment of tax for applicable entities, or you could have a deemed payment from the standpoint that cash would be refunded to you. In essence, it allows the taxpayer to receive a dollar for dollar benefit from the credit in cash, as opposed to needing to have tax capacity. There are some anti-abuse provisions. Direct pay is very, very broad. It applies to all of the credits that are cited on the screen, from renewable electricity production down to clean hydrogen to the advanced manufacturing production under 45X, the clean fuel production. So direct pay is very, very broad. But it also applies to carbon capture, 45Q and 45V. And again, applicable entities now can invest directly into projects and turn their credits. So when we think about endowment, foundation, and pension plans, we're going to see more of those being invested. The transfer of sale credits is probably a very large, significant paradigm shift. So the Inflation Reduction Act basically has now sanctioned the transfers or sale of credits. Pay attention to the last bullet, no tax effect. It's available to all taxpayers around clean energy credits. So if you have solar credits, or you have investment tax credits dealing with your manufacturing facility, or production tax credits, you can transfer them for cash, but it must be to an unrelated taxpayer. There's no tax consequence to the seller, and there, of course, no deduction for the buyer. So it's really going to open up a new revenue stream for manufacturers who are, or who have tax capacity to utilize the credits that are generating, but then they also want to create that revenue stream. This is a simple example of probably how the transfer of credits is going to work in the future. You got a credit buyer, you got a developer. That could be you as the manufacturer in your facility. The bank may have a loan, but there's also guaranteed loan programs. And then you've got the project, if you will. So we've covered a lot of information today. This slide deck and the comments that I've made will be available to you. If you have any questions at all, this is my email. And I'd like to say thank you for attending today. I know it was a lot of information. To the extent you have any questions attributable to tax legislation and what we expect, and most importantly for manufacturers who have questions around CHIPS as well as all of the credits contained in the Inflation Reduction Act, please do not hesitate to reach out. We're here to help you. We hope you have found this informative. And again, the PowerPoint will be available to you. So the other comment I would make is we have recently recorded podcasts specifically around the CHIPS Act and the Inflation Reduction funding. We didn't have time today to talk about the Department of Energy Loan Program Office and all the grants that are available within the Inflation Reduction Act, but we would encourage you to go and listen to our podcast to take advantage of the CHIPS Act, the Semiconductor Act at $250 billion, and of course, all of the IRA funding provisions within the DOE. We also are releasing a new podcast around 45Q and carbon sequestration credits, and what does that mean, and how do I maximize and monetize those greenhouse emissions, and how can I sequester the carbon to ultimately become carbon neutral. And this will be important in your ESG policy. So thank you all very much. We greatly appreciate. Let's keep the conversation going. Follow us on social media. Please feel free to reach out. Thank you and have a great day.